Before we get into today's video, some regulatory compliance. My name is Andrew Alexander. I am Head of Investments for Three Counties, an independent financial advisor based in County Durham, England. This video is for anyone who has an interest in investing and investment markets, both retail clients with no experience of investing through to industry professionals who invest for themselves and their clients. As independent financial advisors and wealth managers, there is no commercial relationship between ourselves and today's guest. The purpose of this video is educational, and in no way should any of the content be construed as advice, nor is it an enticement to invest. Past performance is not a guide to future performance, nor a reliable indicator of future results or performance. The value of investments may go down as well as up and is not guaranteed. Therefore, investors may not get back the amount originally invested. And now, onto the video. Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. The story of 2021 was the unrelenting growth within developed market equities, but while the West soared, the East somewhat lagged. However, is 2022 the year to consider or increase your allocation to Asian equities? To answer this question and more, I have the huge pleasure in talking to Ewean Markson-Brown, manager of the recently launched Crux Asia Ex-Japan fund. But first, before we get into the content, as ever, if you haven't subscribed, it would be ideally wonderful if you could. It really does help us in delivering the weekly investment management and financial planning content to everyone. And that's begging. It's the weekly begging over with. So if you haven't subscribed, please do. Onto the content. Many thanks for joining me today, Ewean. Asian equities lagged developed markets in 2021. Is it somewhat foolish to write them off for 2022?
Well, pleasure being here. And maybe let's just start with why did markets lag? And really, it was China. If I look at the broad emerging markets, it was the Chinese index which really lagged. And why was that? Well, there's a few things. First of all, you had an economic slowdown, and that economic slowdown was really government induced. So it was a government crackdown and induced slowdown rather than anything which happened from an external point of view, and that really was centered in their property markets. Mm-hmm. Secondly, you had a regulatory clampdown, mostly on tech, but also on healthcare and other industries. And again, that really hurt sentiment in stock markets, especially in Chinese stocks listed in Hong Kong or in the US. Mm-hmm. And lastly, you had that COVID impact where China was going for zero COVID, and therefore you had the supply chain bottlenecks, mm-hmm. You had no tourists going around in China, and sort of these lockdowns throughout the country. Yeah. All of those factors together created a pretty negative scenario for the market. And then on top of that, obviously, the US was going gung-ho, the US dollar was appreciating. Yep. That is a pretty negative scenario for emerging markets. Mm-hmm. So going into 2022, where are we seeing those reverse and what else is coming to haunt us? So first of all, we're starting to see, obviously, the US, especially the NASDAQ, start worrying about high interest rates, mm-hmm. Monetary policy, valuation. So that's all playing out. We were just talking before this, but what we're seeing in the US is going to be rising interest rates probably for this year. But Asia might be quite different. Given the economic slowdown last year in China, actually China's in a position where growth has slowed far too rapidly. Yeah. And they're worried about growth falling on the downside rather than the upside. Mm. So they've already started cutting interest rates. And I think throughout this year, we're going to see incremental stimulus to make sure that economy hits its 5% growth target. Yeah. So things are going to feel better, definitely, from where we've been for the last 2 quarters. Mm-hmm. The question in our mind is how much of an improvement will that be, how fast will that be, again, depending on that external backdrop. Yeah. The second part being the regulatory side. We think we're at the end of that very tough regulatory period. And maybe just give you a reason for that a lot of the regulatory action was against these big tech companies. Mm-hmm. And it was very much so, well, some of them are monopolies. There was an anti-monopoly law. Some of them were far too control of social media, and there was a general feel that that these companies weren't promoting the social good, but also some of the leaders in these companies are becoming too powerful. Some of these sentiments we might have the same in the West, some of the Facebook, Google, etc. In China, because of obviously that one-party state, they could react much quicker.
Yeah.
But what we tend to see in China is the regulatory system is very soft. You have no regulatory system for many, many years, and that allows these companies to rapidly grow, innovate, create new business models. And then it causes problems, and then the regulator belatedly basically gets tapped on the head by someone very senior and says, go and do something about it. And when they're told to jump, they jump double, and they use a big hammer, and it's pretty messy. And they do this every 3 to 5 years. The last time was in 2018. And then last year. So going by the last 20 years, we think the regulator has, they've done their hitting the head. They've actually set up very broad rules for most of the internet companies today. So actually, we think that pressure is going to come off probably gradually over the course of this year. So incrementally, there's bad news, and probably the market has gone, well, there's probably too much there. And just lastly, it's all about COVID, zero COVID, and how we get out of that. I think broadly for Asia, we've actually either got vaccinated or everyone's had it, with the exception of China. And that's a whole conversation of how probably by third quarter they'll get their vaccinations up and that economy opens up. But again, that's going to be later into the year.
Yeah. So it seems like there's a lot of positives to be considering, certainly, and not only on a sectoral or a geographical basis, but on a diversification basis as well. We're currently seeing what's happening in the West, and people are looking for potential new homes for cash. You've recently set up the Crux Asia Ex-Japan fund. Why should investors consider your new fund?
So I guess one word, and I think that's really alignment. And then, when I'm looking at companies and businesses, what am I looking for? I'm looking for those great management teams which have long-term vision to effectively take their business from today to 3, 5, 10 years in the future. And I kind of sort of look for, I kind of say ability, ambition, integrity, and that alignment between them and minority interest investors over long periods of time. And for ourselves, being in a small firm, it's been great, but there's 4 of us in our team. We're fully aligned with investors. We're remunerated on 5-year rolling performance. All of us within the team are invested alongside our investors in the funds. Other people, in fact, majority of the senior people within Crux, outside of direct investors, are also invested alongside within the funds. And we also own shares in Crux as a company. And being small and that full alignment means that we're, I say, 100% aligned in that long-term vision and really building up a product and a team. So I feel very much like that I am one of the investors, one of the founders of the companies that I'm looking at to invest in myself and trying to build my own business, which again, if we're successful, leads to great success for our investors.
Yeah, that alignment is absolutely key. Let's be perfectly honest. Knowing that the fund manager is invested absolutely in the fund and believes for his own benefit, his own financial benefit, what he's investing for clients within the fund is like I said, it's absolutely key. Definitely.
And it's just to say, what we're trying to do, we're really trying to significantly outperform stock markets over a long term. Short term, there's huge amounts of volatility. There's lots of noise. It's very difficult to have an edge. But if we spend our time sitting back, thinking longer term, 3 to 5 years, thinking about how the world's changing, we think we can create an edge. And when we're looking at that edge, we think the edge really is looking for growth companies. Companies that are adamant and can compound their top and bottom line at 15% per annum over the next 5 years. And that's doubling of revenue, a doubling of earnings, and a doubling of the share price. At a minimum, assuming you get it right. And I think that over the last 20 odd years, it's proven that if you can find the companies which deliver the earnings growth in Asia, you do double your money, and the share prices follow, and you do outperform.
Yeah. Looking at the fund itself, are there any particular investment opportunities you're seeing at the moment, and how are you actually playing these?
So I guess I've got two big pitch ideas, which I think will be here for the next decade or so. One is effectively the digitalization of everything and the electrification of everything. The digitalization of everything's going to go online. And the reason that's going to happen, and it continues to happen, is that you can see your son and you can see both your children's children, their children's children. Every single generation is more digital savvy than the next. And therefore we know society will incrementally change towards more online. And it's inevitable. And I think that process is speeding up. And the second part of it is electrification. Effectively, the move away from fossil fuels to greener energy, alternative energy, means we have to electrify anything. That is actually, I think, a much better way. Electric trains, electric cars, etc. So these are two big themes where, well, how do we benefit from this? One of them, we think it's electric vehicles. We think China is going to be a world leader in electric vehicles, especially in terms of the supply chain. So we own a company called COUNTIL, which is the largest producer of batteries globally. But what really excites us is that all the supply chains in China. So you've got the R&D, the innovation that's occurring in China. So maybe it's Tesla who produces the final vehicle, but the parts that go in are largely going to be produced in China. The other part of that is that we are very excited by the battery materials, copper, lithium, and nickel, where we think the demand will far outstrip supply in the next 3 to 5 years, and therefore across the region we're working with companies who can increase the supply of those products. And maybe on the other side, it's really the digitalization of everything. How do we do that? Well, we need semiconductors, and we need lots of them. And we think the market is underestimating the demand for this growth of semiconductors. And that's really because analysts who have covered these companies for the last 10, 15 years have focused on two big trends, the PC and then the smartphone. But going forward in the next 5 to 10 years, the PC and the smartphone, there's no growth in those two markets. And they're not the drivers. The drivers are electric vehicles, AI, VR, cloud-based servers. And all of these have completely different demand dynamics, ASPs, power needs, than the smartphone or the PC industry. And we think they're all accelerating their growth in the next few years. And it's really hard for analysts to understand the impact because they're all distinct segments, they have different ASPs, and therefore it's much harder to build a model. So we think that the overall semiconductor market is going to be very tight. So companies like TSMC, companies like Samsung, but if you also, companies that can solve some of the bottlenecks are going to be really exciting that as part of that portfolio.
For me, when I look at Asia, and I'm assuming a lot of investors look at Asia, it is about innovation. It's about the driving growth. It's the real heart of the growth, global growth opportunities. And we are, as we mentioned before we started recording this, the whole world is looking towards the West, certainly looking towards America and trying to work out what's going to happen next. But you have got different issues that can provide huge amounts of diversification and a different type of return that you can get in Asia. And for me, as someone who puts together portfolios, you've got to look at diversification. Diversification's key. And although, the Asia against developed markets lagged last year, you shouldn't write them off. The diversification benefits are there, and so it's going to be a fascinating year anyway. What's going to happen? We've already been talking about it. How many markets like this have we got to go through, because they're all nuanced, they're all slightly different, and the amount we learn from it at the other side. But thank you very much for your time today, Ewan. It's been an absolute pleasure to catch up with you again. You stay safe, and I'm sure we'll catch up soon.
Thank you very much.